Hello, welcome to the end of day review for Thursday, September 26, 2024. Normally we do the end of day review after the markets close, but we couldn't do on Thursday, so we do this episode on Sunday today. So the heads up right there. So on Thursday, September 26th, we have the low to medium impact news, which is the GDP data, come out at 8:30, and let's look into how the markets impact with that's new right there. All right, we look at the charts right here on 15 minutes. By the way, we just mark the range right here is the PM range of the Wednesday, which is Friday, and the New York PM range, and then the London range right there. So we have a very perfect setup for short. We have right here the 8:30 right here. Before that, if you look at this candle at 8:15, right before 9:30, you see the high right there. Basically, you see a setup right there. Test one, test two, break and reverse. That is a type 2 reversal right there. And also we see that right here is 1, 2. You see it right the London high, which is a buy sell liquidity. It rate twice, 1, 2. That's called double push right there. It's a very perfect setup. And we can go in and short right away at 9:15 or at 9:30. We go in and sell them at the high. And here's at least this setup gives us a next question we have for us to find a model. So when it comes to 9:30, we have two options. One, we wait for the 9:30 candle formation, then we know how to trade them. The two scenarios right there. Or we can go in this case, we go in and short right away. So let's see. So that's two options right there. The high of this candle is 58.2750. So it's two scenarios for us. We wait for the 9:30 candle formation, or we go in and in this case we saw a short, we start breaking, we short right away. That's two scenarios. In today, Thursday, we can short right away. You see that is set up because we see that right here we have a confluence, the double push, and then we have the type 2 reversal forming right before 9:30, which is 9:15. So those two key factors that give us the confidence or the conviction to go in and engage right away at the 9:30. Most of the time, we still collect our data and build up the model or build up the statistics for our model, which is when we're gonna go and engage at 9:30 right away. And when we should wait for the 9:30 candle formation. So that's the model that we try to build right there by itself. So basically the model we try to do is first, right, we wait for the 0930 candle formation. Second scenario, which is no way, you don't wait, because 915 setup already there. Just go in and go with the direction of the 915. So no wait for the candle at 930 confirmation. We can engage right away. So that's two options we have right there. And Thursday, it fall into this option number 2. Our theory right now right there is, we don't know, we have to collect a number to view this, but let's assume 70% is more the time we have to wait. And maybe this is just 30% of the time we collect the number. So let's see. So we have to wait or not waiting for 930. We have to build our model based on the numbers, based on the statistics that we're gonna collect it. And so that gives us the confidence, that gives us the conviction, or whether we're gonna engage right away or we wait for the 930 candle formation. This is gonna be huge for us, because this is gonna give us what? It's giving us the direction bias, or in terms of ICT language, it's called liquidity run. You want to see where the liquidity want to run, right? With direction. That's the idea right there. You know, direction bias or liquidity run is the same idea, the same concept, just different terms, different, vocabulary right there. That's the model we try to focus. So first we know that we have a setup, but then the next component in our model is that we should stay in the trade long enough to reach the targets, or we're gonna get out right away. Because if we know the liquidity run or the direction bias, then we're gonna stay in the trade long enough for it to hit our targets. So and we execute the trade with a conviction. So the element for a trade setup right now, based on our model, is that you have two key elements. First is the setup, the entry, when you're going to see the entry right there. So basically we put a sell stop right here. And then the second component is the execution. In order to help us with execution, the challenge, the struggle we have is that we don't know when, right? We have the direction right in this case, but in this case, let's say we go in right here and this guy go back all the way there. So, and let's say we gain, right? We go in right here and then we gain about, half an hour right there, 3 points. And this guy go back, take us out again. So the next question we have, should we stay in the trade? In this case, is lucky enough it did not hit the break even. If we move our stop loss low to the entry, then we are break even, right? So if it hit our break even, are we still stay in a trade, or we gonna have a conviction, or we have a high probability that it gonna continue to expansion to the downside? All right, in order to answer that question, then we have to view the statistics about the clearance, and the 930 is the key right there to see whether we engage. In this case, we can engage right at the 930. Look at the tab right here. We have a double push liquidity. Let's look at the tab. We do a recording right there. Okay, so you can see that the 7 o'clock right there, right? That is, it rate the London high the first time, and then it rate one more time of the candle at 9. So you have a double push theory right there, right? Double push theory. That means it rate liquidity twice, the high or the low. In this case, we're talking about a high, then it can reverse. So we have two concepts right here, right? Our the basic for us is the type 2 reversal, but we try to put into the context of liquidity, so we can stay in the trade. We can take the trade with conviction, and also we want to know whether we want to wait for the 930 candle formation, or we can engage early. We don't have to wait. So that's two concept right there. Oh, I mean three concept, three factor right there. First, the setup, type 1 accuses type 2 reversal, and then the double push, factor right there, double push, and then the 930, wait for 930 or not. That's three factor for the trade setup. And you see that right there. Let's keep roll the tab. You see that? As soon as the 930 coming, so 27, 30. Okay, hold on. Okay, 29. Let's see. You're gonna see that. So basically, it swept the buy side or the high of London twice. So it's called double push right there theory. We're gonna look into that. You see, 930. At first, it feels like it reversed, but it not. It's continue direction of 915. Yes. So in this scenario, we can engage going short right away, because the liquidity already double push, and we have a huge sell side liquidity down here, and we see that the London curve range right there. So it's expansion, consolidation, or retracement. Then it's go to reverse. See, reverse. See there? Yeah. Yes. See that? And let's look. Okay. Yeah, that's one look like it's gonna reverse. But that's the trick right there. So when we engage, should we stay in the trade? Because it just rate the London low. But if we understand the direction bias, you see that there, it looks scary. It looks like it's gonna reverse from here. You see that? It looks like, if you look at the level, you see like break, test from below, and reverse. That's very key for us right there. just pause right here, because in the real time it's very hard to stay in a trade if we don't understand the direction bias or the equivalent. Or it look right here, you see it mark right there, you thought that that's what we did. We did take a long trade right here, and that really, if we look in the real time right here, well, we say what the high of this one, 58.60, 58.60. All right. It gives us, I think we messed up, 58.15, 16.50. So after the fact, we see the clearly, right? But in the real time, it's a tough job. That's the reason why understand liquidity helper. Even though we saw the setup, we see the setup, but the execution very critical. In order to help her to execute the trade better, we have to understand the liquidity run. And in this case, even though it looks scary, it go back. But if we understand liquidity run, that it's gonna take all this buy sell liquidity, because it just double push right here, and you have a fall breakout reversal type 2 right here, then just stay in the trade no matter it looks scary, regardless scary looking on. But right here is a fall setup right here. You see that break test from below. We thought it's gonna reverse from here. After the fact, it doesn't look reverse to us at all, to you at all. But if you look in the real time with the tap right here, you thought that it's gonna reverse. Who think that it's not gonna reverse? If we look at our model, which is type 2 reversal, you have, oh yeah, no, it's not, because this, yes, it does. You see, here it break it, and that's from below. That's right. Let's look at the model. Here it is, our, bread and butter model. We trade two setup. One of them, the second one we trade is fall breakout reversal type 2. So you have three steps. Right? For test from below, or this case, we're talking about short setup. So test from below, that's, yes, from below. This is a test from above. We misspoke right here. So right here, test from below. Break and reverse. That is the type 2 reversal right there. Right? Test from above or below. Either from above is a short setup. You see, it gives us. From below is short setup, but from above is a long setup. So in this case, we're talking about a short setup here. So test from below, break and reverse. So look at that setup right here, right? We have a test from below twice. 1, 2, 1 at 8:30 when the GBA data release, and then test one more time at 8:55, break it, and then it's reverse. So 9:30 we go in and engage right away. Don't wait for the 9:30 candle formation. So that is the theory we have right there. When we understand that a double bottom happen, then we don't have to wait. You see that? Okay, and right here is the, if we understand it, we stay in the trade, we stay in the trade longer. Right here, we see the setup right here at 10 o'clock. You see that? In the real time 10 o'clock, we thought it's a reversal type 2 right there. You see that? It will mark the high right here. Like we did right here, we see break, test from below, reverse, which is on the reversal type 1 right here. You see that? Break, test from below, and reverse. But right here we have just a little bit different. This one has to be up close candle, not up close, but it's yeah, up close candle is be more reliable. In this case, it's a down close. So that's maybe the detail right there. Give us a little bit of hint that it may be bearish right there. Yeah, the strong one is gonna be a up close candle. Yes, absolutely. Yeah, it should be up close, and then we both down close right there. See that there? That's from below. That's from below. Break and reverse. Okay, so right here in the real time it can kind of mess it up. We may get out of the trade early, but if we understand the mechanism behind the thing, the liquidity run, then we can stay in the trade longer. All right. Now look at the double push theory right here, real quick. Yeah, here's the guy on the Twitter right there. You can see that he's talking about double push theory. It is a little bit different than what we are understand. In our scenario, it just basically it pushed the liquidity twice. But in this scenario, in his theory, he say that it's both side, basically buy side and sell side, right there. Basically, it rate the buy side and it gonna come right the sell side right there. And you see the level right there. It rate the buy side and it come down. It rate the sell side and then it boom, it go. Similar to this. This is like a stair right there. But the double burst theory we are talking about here just slightly different. Basically, it rate liquidity twice. The same liquidity twice. In this case, it rate at 7, the buy side liquidity, and then it rate one more time at the 9 o'clock, and then it reverse. So basically, the nomenclature or the retail language, this we call double bottom, double top right here. Top 1, top 2 is called double top right there. Let's keep let the language simple. We don't want to do double burst because that can be a little bit confusion and a little bit confused with the double burst theory. So let's keep double top right here. Top 1 and then top 2. Basically, it rate the liquidity twice. Double top right here. You see that? Top 1 and top 2 reverse, and it gives you the setup. If we see the double top, but we don't see the reversal pattern in this case is the type 2 right there, right? Test, break, and revert type 2. You see that here? Test, break, and reverse. If we don't see that, we don't take the trade either. So the condition for her have to be double top first. And then you have 2 conditions. Right? The first condition has to be double top. Liquidity is right there. It's ready for the reverse because it have built up a huge sell side liquidity right here. So it's gonna go down and drip that sell side liquidity. You see it go all the way down. But it's to the mid range of the Friday PM right there. So that's the setup that we find is very interesting to do a deep dive and learn. Let's see what the write-up we have. We didn't do any real write-up, so let's do the write-up right there so we can put into our journal. So basically this is a we need to give the timestamp right here. So it's a 707. So this one is 7 o'clock. So you have the rate right there. And then you have a second rate right here at the at the 9 o'clock. Alright, perfect. And then here's the 9:30. So we're gonna go to the right. Beautiful. To fix the time right here, so basically 9:30. So we have a little bit time reference right here, so it's the 9 o'clock. All right. So and that's it. We check this screenshot and do a little bit write up. So basically, hold on. We need a little bit time, reference time, so we know. So here's 8:30. No, 18. When it open in the Asian oven, so we have a little bit reference, right? We have to do that because when we look into the screenshot, it gives us the date, so we know that day is 25th right there. 25th, is that right? It's the 25th? No, 26th. So 26, so let's keep the time right here. Okay, the 15 right there. Let do the screenshot again because we want to guess the time. Exactly the time, right? Okay. So that's our target. All right, our target. All right, so make it a little bigger. So we have a Friday and then we have a London right there. It's very clear. So what we try to say right here. So now, like usual, right? We have this test from below. And then you have break. The level we're talking about right here is 58, 27, 55. And then you have a reverse. So at 9:30, we just follow up. 9:30 is a follow up, so we can go engage right away. So basically, here's what we're gonna put in our write up right here. So we're gonna put right here. Alright, so put this spot right here. So basically we have a 4 breakout. At what level? At the level 58, 27, 50. And that is equivalent to a reversal. Because whenever 4 breakouts means it turns into a reversal or retracement in this case, or other case, reversal. Type 2 for it right here. Remember, reversal type 2 right here. Basically, you have it tested first, break, and reverse. Yes, so we have that. We have a test, in this case, from below. 2 times right there. And then we have break it, and then reverse. So now we have to go beyond this so we can stay in a trade. Otherwise we get out of here because we see that, we're going to be reversed from here, but it's not. So how do we know we're going to stay in a trade longer to hit target? We have to understand the equivalent. And right here we have the note should tell us right there. The first note we have is we have a double, I think it's double, yeah, we can say double top matter, right? Double top formation, right? One as 7 o'clock and the other is at 09. Basically, the buy set up really rate twice. That's what we mean by double push in our theory. It's a little bit different than the other guy, but that's what we mean. So let's go keep the double top for double top, right? Let's go with that. And then second, we can see that what we see it right here. Yeah, we see the Asia, or before London is the Huron, right? We see another huge run. Huron from BM, Friday, BM to London. So so it's a huge gaps right there. Huge gap. And then we see that the London is kind of in consolidation. Yep, so that's our note right there for the beautiful setup. And we know that in this case we don't no way for 0930 candle formation right there. CF stand for candle formation. I think we did do the ray up somewhere, but we couldn't find it right now. All right, here's the beautiful ray up we have right there. And this fall into the scenario that we don't have to wait for the 930 candle formation. But the next question we have, we need to do the deep dive right here related why it cannot go up, right? What is this that it cannot go? Why cannot it consolidate right here and make expansion? And not like up, but it have to reverse. Okay, let's keep that question in mind. We may come back because we run out of times. But anyway, that's it for this episode. End of day review for Thursday, September 26, 2024. Thank you for your time and interest. We're always grateful for this opportunity. We do what we love, and success coming our way. Day by day, little by little, in every way, we're getting better and better. Bye for now and see you later.